let's talk about the big newsmaker yesterday post-market hours. We had the numbers for Infosys come out, and IT bellwether Infosys delivered a miss on all counts in the final quarter of FY24. Even the beat that came on profit was largely led by other income. Let's go across to my colleague Anisha Jain for a fine print of those numbers and what disappointed the street so much. Anisha.
Well, Infosys reported another miss in the quarterly earnings and a big disappointment at that. The constant currency this quarter declined by 2.2% as compared to our expectation of just a 0.4% decline. So a sharp miss on the top line itself, and that trickled down into the operating performance, with the margin coming in at 20.1% versus expectation of 20.7%. So on a sequential basis, there was actually a decline in margins versus the expectation of an expansion. Profitability, however, optically is looking much better than expectation at over 7,000 crores. But do remember, the other income is actually higher, and that's the reason you're seeing a profit beat. But otherwise, it's operationally weak quarter. Not just that, even in terms of guidance, there's a sharp miss coming in. The company is talking about a growth of just 1 to 3% in constant currency in the coming year, that is FY25. This is much lower than what Street was expecting. Remember, part of the Street had factored in a 3 to 6% kind of growth guidance as well, and the weakest on the Street had an expectation of at least 2 to 5%. So 1 to 3 is a big departure, at least on the higher end of the range versus the Street expectation. The dollar revenue also came in at $4,564 million, below our expectations. The profitability, as I talked about, was just better on account of one-off. Though the deal win number is quite strong, $4.5 billion is actually much ahead of expectation, because Street was talking about a number of maybe $2.5 billion. So that's the only silver lining in the number, because other than that, it is a big miss coming in across the board. The management says that they are looking at excellent traction from clients in generative AI, and of course, they've announced an acquisition as well of almost 450 million euros. But the ADR is already reacting negatively to the big miss that we have seen coming in from Infosys this time around.
All right, thanks Anisha for that update. Let's also listen to what the management had to say as well.
On the revenue, what we are seeing is the environment in terms of discretionary and digital work is similar to what we've ended in this year. We also had good traction in large deals, some of which will flow through in the next year, given the duration of those deals. Keeping that in mind, our growth guidance for next year is as a band higher than where we finished for this year. While the difference is small, it's still higher from where we finished this year. As we go into the industries, we see, for example, financial services to see a better outlook in the next year compared to the past year. And given the outlook with the discretionary spend and digital work remaining same and more focus on cost efficiency and consolidation, we've created that revenue growth guidance.
On the net headcount increases, if you look at it, when we started the year, we were at 77% utilization, including trainees. The growth environment also was different at that point in time. We had guided differently. So, we had to realign some of those factors as the growth environment changed. Our utilization has now gone up to 82%, including trainees, 83.5%, excluding trainees. That's one of the tracks under Maximus as well. Our attrition has also come down significantly, right? So that's the reason why you see a net headcount reduction. And we also have changed in last few years our hiring model significantly. So we no more hire all the freshers for campus. We hire less than half of them from campus, and the rest we hire off campuses. So we have that agile model. So we will look at hiring as the year goes through.
All right, that's the word coming in from the management at Infosys. But here's the...
If you like this video, then like, share and subscribe to ET Now.